So we have a bit of news coming out just recently from Better. BBT is the ticker code there, of course. It is providing a trading update, talking about growth in turnover, as well as a bit of a share buyback. So that's getting across small cap news, and I just happen to have a small cap investor in studio with me to discuss what investors should be looking for, should be looking ahead to in 2026. Really pleased to welcome Gregg Taylor from Salter Brothers. Gregg, nice to see you.
Yeah, thank you. Good morning.
I haven't had the chance to speak with you for a while, so I will do the old 2026 crystal ball gazing.
Yep.
Do you think it's going to be a good year for small caps?
I do. I think what we saw in 2025 was small resources had a phenomenal year, right? Up 70%, which is remarkable, which shows one of the key ingredients for small cap performance is risk appetite, and that's definitely back on from both the retail and even the institutional investors. So I think that's a good sign. I know everyone's enjoying the run that resources are having, and the gold and a lot of the other sort of resource prices continue to be strong, but I think it's inevitable that we're going to see a rotation out of small resources into small industrials. I think the old adage of sort of buy low, sell high, I think it gets a point where the risk versus reward trade-off of industrials versus resources is now getting pretty extreme. And it mightn't be this week or this month, but I foresee over the next couple of months a rotation back into small industrials, which are still fundamentally undervalued, not only relative to resources, but very importantly relative to mid and large cap Australian industrials. So.
Now, I don't know if you would have heard, but I was just reporting on Morningstar saying that there could be a wave of M&A with some of those bigger players taking on junior explorers.
Yep.
Do you think that the same potentially, obviously different dynamics, but that M&A will continue to be a feature in the smaller end of the market this year?
Oh, absolutely, for a number of reasons. So firstly, on comment around the resource M&A, I absolutely agree with that, and it's a typical late stage behavioural trait where you get the big uplift in valuations, and then the value of their equity is quite high, so they can use that for M&A. So yeah, absolutely the logic that you would likely to see more active M&A in the resource sector. I absolutely agree with that, but what you've seen with the small industrials is that's been pretty continuous. And one thing, and I might touch on later about one of our key picks for 2026, we're seeing increased activity from private equity. So private equity have been sitting on large piles of cash for quite a while now, and they've been waiting for a more stable interest rate environment and more macro environment to really deploy that. There's a lot of action underneath the surface in 2025, but a few of the macro dynamics maybe put a few transactions on hold in 2025. So I think we have a more stable macro environment over 26. You're going to see a lot of M&A both in resources and industrials, and typically small caps are beneficiaries of that.
Now, Gregg, I can't help but just reference back to the fact that you joined us for our Small Caps Big Ideas it was last October now.
Yep.
Time flies.
Yeah.
Simul was one of your key picks. I can't help but notice that dovetails with what you're saying about small cap industrials. It's been quite active, or at least it was toward the end of 2025. Acquisitions, I believe it secures $300 million of debt to fuel further growth.
Yep.
What's your report card on all that activity?
Yeah, so look, Simul was a hidden gem we spoke about, and again, classic behaviour, but the stock price moved from below $2 to up to $3.50. I think it might be at $3.40 today. So, the valuation effectively doubled in the last 3 months, which is pretty remarkable.
That was a good pick.
Yeah, it was, but it was for a good reason. Again, as you touched on, they won a number of significant contracts, and also started using the stronger currency of their equity to make some M&A. And so I think those dynamics will continue for Simul. They're still trading below their peers, even though they've doubled, but there's been earnings growth off the back of the contract wins and the M&A. So they're still looking attractive from a valuation perspective, a lot of momentum, but increasingly, as their equities got more value, I think they'll be more active again even in 2026. So the outlook remains positive for
because
Simul.
they did have big growth plans. We spoke with the CEO. I'm sure you can find it still online someplace if you're interested. But when you see such exponential growth like that, people always question whether that rate of growth can continue. Even if that rate of growth slows slightly, does that destroy the thesis in any way, shape, or form?
Look, I don't think so. Again, it's when we spoke back in October, it was trading at a valuation differential to its competitors on the ASX, like similar companies, of circa 50%. So that valuation arbitrage is closed somewhat, but it's still trading at a 10 to 20% discount to its peers, but it's got superior growth, both organic and inorganic. So I think the superior growth profile, and it's now getting close to $1 billion company from a market cap perspective. It's got $300 million of debt facility to use. So it comes on the radar screen of larger investors as well. So it was anything under $1 billion. A lot of the mid-cap investors find it hard to build a position, but now they can in a company like Symal. And it's very common for small caps as they transition from 500 to $1 billion. They have another kick beyond $1 billion because they've got a whole new investor universe to look at. And if they're looking on pure fundamentals, superior growth, cheaper valuation and good quality, I think it remains attractive.
Well, Greg, this wasn't planned, but Better was also one of your key picks back in October. Today, we just learned that it will be buying back some shares. Also, seems to me, I haven't read all the detail, pretty positive trading update. Maybe you can fill us in? Yeah,
look, and Better, or BBT is the ASX code, hasn't had the same share price performance as Symal over the last 3 months. It's been pretty flat, but that fundamental value that I pointed to, and remember, just to recap, they're sitting on a large. They try to acquire the PointsBet business, and they raised money to do that. They were unsuccessful, but they also took a strategic stake in PointsBet. So the value of their PointsBet shares that they still hold, and they hold about 28% of those. They've got strategic value, and they're sitting on a lot of cash. And so if you value the company excluding the value of the shares of PointsBet and the cash, it's on a low single-digit multiple. And what it's come out today is two things. One's prove that it's outgrowing the market. Volume growth for the business was 25% on the quarter, so winning market share. A dynamic consistent across the entire industry was the racing carnival in November was not very profitable for the bookmakers. So they point to a targeted 10% win rate on their book. During that key November trading period, that they were below that 10%. What they've announced today is since November, December and January again are back well above that 10% target range on 25% higher volumes. And they're voting with their feet now. They're saying our shares are so cheap, the best thing we can do with our cash at the moment is buy back our shares. So share buyback's been announced today. That's normally quite positive for share price performance. And I think, again, what they're really trying to do, if you look fundamentally or strategically, they're trying to increase the value of their equity so they can participate in more M&A. And again, they put that in today's announcement that they're progressing on some M&A opportunities. And there's some big ones and high profile ones that I believe that will come to market in the next 3 months. And Better are the best place to take advantage of that, and that could be very accretive, and again rocket this into a $1 billion plus company, which would be very interesting. So keep your eyes on that one for the next 3 months.
Well, just as we've been speaking, it was 4.5% higher. It's now 8.7% higher.
Yeah,
so there you go. We'll keep an eye on that one today. So given your form, Greg, I will anticipate that you won't mind me asking you for a small cap pick for 2026.
Yeah, no, for sure. And look, we've had these conversations over the years, and I've always spoken about individual companies, and but sincerely, the greatest opportunity I see at the moment, which is listed small cap exposure, is SB2, which is the listed investment company that I manage, which is a diversified portfolio of 30 small cap industrial names. Why it's so interesting is it currently trades at a 30% discount to its net tangible asset value. That's not completely uncommon in listed investment companies, but typically it's closer to 10% discount. So it's got a large discount, and one of the reasons for that discount potentially is around about 15% of the portfolio is held in unlisted investments. And what we've made public, and so is we're in the process of exiting those unlisted investments. We're very progressed in a number of exits at very attractive prices relative to their carrying value. So we expect that an outcome on that in the next 3 months, at least on 2 of those holdings, which would be greater than 10% of the entire portfolio. I think it's going to be a meaningful catalyst for the business if they were successful, those exits of those unlisted. So we spoke about 85% of the portfolio is exposure to diversified small cap industrials, which I think are in for a good year. And secondly, you've got this catalyst of the unlisted portion to be converted to cash. And then we'll start looking at things like special distributions to investors. So really encourage people to have a look at that because it's a pretty unique dynamic at play at the moment.
And managed by you?
Managed by me.